Here is a number that tells you almost everything about where big oil is heading right now. 4 gigawatts. That is roughly the entire onshore wind and solar portfolio Shell has just agreed to hand over to its French rival, TotalEnergies. The agreement was announced on Monday, the 3rd of August, 2026, and as of today, Tuesday the 4th of August, it is the biggest story in European energy. Note what Shell is not doing. It is not trimming its European onshore renewables arm, or selling the weaker half. It is selling all of it. Every operating farm, every project under construction, every megawatt in the development pipeline. And the buyer is a company doing almost exactly the opposite of what Shell is doing. So what is in the box? Around 500 megawatts is already generating or under construction, concentrated mainly in Italy and the Netherlands. The rest, taking the total to roughly 4 gigawatts, sits in development across Germany, France, Spain, and Poland. Completion is expected by the end of 2026. Now the interesting twist. TotalEnergies plans to sell on half of that portfolio and keep 50% for itself. That is not hesitation, it is capital discipline. By bringing in a partner, Total recovers cash quickly, shares the construction risk, and still controls the pipeline it just bought. Shell's logic is the mirror image. Under Chief Executive Wael Sawan, the company has spent 3 years prioritizing returns over sheer volume, and low-margin onshore power simply lost that internal argument. Why should this matter if you are not an energy trader? 3 reasons. First, Shell's exit removes a deep-pocketed developer from European power markets at precisely the moment governments are relying on private capital to build generation and grids. Fewer serious bidders in renewable auctions tends to mean less competitive pricing, and those costs eventually reach household bills. Second, consolidation. European renewables are pooling into fewer, larger hands, with TotalEnergies positioning itself as an integrated electricity company while Shell doubles down on liquefied natural gas and oil. Third, investors have consistently rewarded Shell for that discipline, which is exactly why the retreat keeps going. The market is paying oil majors to be oil majors, and this deal is that incentive made visible. Near term, watch 3 things. 1. The timetable. Both sides expect to close by the end of 2026, which means clearance from regulators in Brussels and in several national capitals over the coming months. 2. Who buys the 50% stake Total intends to sell? Infrastructure funds and pension money have been circling operational European wind and solar for years because the cash flows are contracted and predictable. The price that stake fetches will tell us what these assets are genuinely worth in a higher interest rate world. 3. Whether this proves contagious. If Shell can walk away from European onshore renewables with its share price intact, expect other majors to test the same door. BP and Equinor have already scaled back their green targets. So here is the takeaway worth remembering. This is not the collapse of Europe's energy transition. It is a change of landlord. The turbines keep turning, the panels keep generating, the electrons still reach the grid. What changes is who owns them and what return they expect. Shell has concluded its money works harder in gas and oil. TotalEnergies has concluded that owning electricity from generation all the way to the customer is the stronger long game. Only one of those bets can really be right, and the next 2 years of European power prices will settle it. Keep your eye on that 50% sale. It is the number that will reveal who blinked.